Happy New Year. I hope everyone had a great holiday season. And we're already off to a pretty decent New Year start. I had done my weekend review, and a lot of what I had discussed has been playing out. A couple of things that I think people might find interesting. I did a couple of polls at the end of last year. One was, will January be an up month or a down month? And the vast majority of people thought it would be a down month. And the same thing with the opening week. People thought that this week would be a bearish week, so people didn't come in with a lot of euphoria. What impresses me is that the market is basically at all-time highs, give or take. I mean, basically you're a stone's throw away. If you sneeze, you could probably put the Dow over 20,000. But people aren't really very bullish. They're actually rather pessimistic or bearish. Today, I started to feel that changing a little bit. So, first and foremost, what happened today? Let's just get that out of the way. Today was a little bit of hangover of what happened yesterday with the Fed decision. It really wasn't a Fed decision. It was more the minutes. And I had a sneaking suspicion they were going to be hawkish, given the fact that the Fed surprised at the last meeting. Instead of 2 rate hikes for the next meeting, they decided that they're going to do 3, and that's the German 3, by the way, 3 versus 3, the American 3 and the German 3. Anyway, getting very fancy here, since a lot of this has to do with the Europe anyway. So the Fed's minutes were a little hawkish, and they mentioned that they may have to raise rates quicker if growth picks up faster. Now, last night I had put out a tweet, and I basically said that I was going to savage the Fed today for what they did, and I think I'm going to take a little bit more of a calmer tack to it, and I'm going to explain why I'm so angry at what the Fed is putting out here. First and foremost, the economy for the last 8 years has been very weak. And that is the reason why the Fed has had to basically adopt and maintain zero interest rate policy. It's not because things have been going well. The employment situation is pretty awful. A lot of that I can't blame on politicians or any factors other than the fact that technology has improved to the point where there's a lot of automation and soon to be artificial intelligence that is going to be basically kicking people out of jobs. That's a big macro trend. But, and here's the big but, a lot has had to do with policy. Obamacare has basically ensured part-timing and offshoring. You have had no fiscal contribution to the economic picture for the most part. You've had a lot of regulations heaped on that a lot of companies didn't understand, or they were punitive, and they basically didn't reward entrepreneurship or growth. In fact, it rewarded entitlement and dependency. And for the first time now, after 8 years of whining at the Federal Reserve about having to wanting to get more fiscal stimulus in, now they're getting it, and the first thing out of their mouths is that they want to jam on the brakes to slow down the economy. Janet Yellen I had actually started a couple of, it's a while ago already, I had started to turn my view from being more bullish to bearish, and Yellen's I call it her come to Jesus moment, shifted me back to being more bullish. I'm just looking for the date that was. I think it was 4/12, if I'm correct. I don't think I have my chart back far enough. Let me see. Hold on. Just bear with me a moment. We'll get there together. The Fed day, yeah, her come to Jesus moment, was 3/29. We had just had a big decline, and the market had started to rally back, and I was actually waiting for that rally to short until Janet Yellen opened her mouth and she changed the narrative. They had just hiked prematurely, the prior year, and the market didn't like it, and we had a very weak first quarter. And then Janet Yellen basically came out and said, "I'm sorry, I didn't mean it." And when she said that, I took her for her word. And she talked about things like symmetry, meaning she would allow inflation to go past their 2% target to make up for the time that had been below 2%. she had talked about a lack of visibility for business investment and how that they were going to let that run a little hot. And in recent minutes, they've even talked about letting the economy run a little bit hot. Why now that this is now first starting to happen, are they not saying they welcome that and that they are going to remain accommodative to foster growth? This is their shot. It's sort of like that Eminem song. If you had one shot, one opportunity to seize everything you ever wanted in one moment, would you grab it, would you capture it, or just let it slip? And I'll tell you, if the Fed gets silly here and they start hiking, if they do the 3 rate hikes and we don't see the growth, if there's any stumble step, if the Democrats put up blocks on Trump's growth policy, or there could be a geopolitical event. There could be a natural disaster. Remember in 2000, I think it was 11 or 12, we had the Japanese earthquake, which wound up shaving a lot of points off of GDP, and I think led to like an 18% correction. There's not a lot of wiggle room here. And when I hear that the Fed people, these talking heads who live in this ivory tower over there in Washington, when they're talking about how the economy is doing well and how they're going to run a hot economy and how employment is doing well, I have to ask them, what the hell are they talking about? I ride around in my car very often. I've never seen more homeless people under overpasses, on highways, on street corners. The squeegee men are back. This is absolutely a very different world than the Fed is living in. And I tweeted that out, and I got a lot of responses from people in Phoenix and in Los Angeles, people from all around the country saying they saw the same thing. Chicago, you think that they have that high crime rate because things are going well over there? It's absolutely infuriating to hear these people talk about what is going on with jobs and the economy. You have never had more people working part-time, and yeah, I guess they have their free Obamacare, but they're sleeping in a goddamn refrigerator box. Sorry, I get a little bit upset about this because, this is my city here. I've lived in New York my whole life, and it really pains me to see this. So when I hear this disconnect with people like Janet Yellen who sit and eat, fat dinners on the government's dole, it just pisses me the hell off. And now they're talking about trying to, get more aggressive with raising rates. And I don't know if it's a political thing with them or if they just are that stupid. And I have to say that I don't think it's that they're stupid. I think that they're just out of touch. These people are just absolutely out of touch. And if they believe these numbers that they're putting out, they're going to reap what they sow. And I'll tell you this, if they get silly and they start raising rates really more aggressively before you start having some real sustainable growth, it is not going to be a pretty picture. So this is sort of my warning to them to just go easy. Allow there to be, listen, we've been a 2% economy. It's almost like Stockholm Syndrome. And this is why people were so worried about if Trump won, they wanted Hillary to win because they wanted the low interest rates. That's what Wall Street all thought. They wanted low interest rates. They've been captives to low interest rates for so long, they forgot what it's like when it's actually sunny outside. You can have a growth economy. I've seen it before. I mean, it's just amazing to me. And now that people are waking up and they're realizing that there could be some growth out there, they're getting excited. The market's going higher, and you're starting to see a widening of the breadth. That was actually one of my big concerns in last year. You basically had Facebook, Amazon, Netflix, and Google, and maybe I guess Nvidia, companies with huge growth potential doing really well, and that was it. I mean, those were the only things that were working. Very similar to 2007, you basically had a couple of commodity stocks working, agriculture names like potash and anything associated with oil until that thing broke wide open. But you were narrowed down into these stocks, and that's really when the market starts getting dangerous. Now that you have a guy like Trump in who's talking about growth and maybe bringing jobs back to the economy and getting rid of some of the regulations that have absolutely strangled business here, you're starting to see a widening of the breadth that's very healthy. You're starting to see the banks for the first time in ages come off the mat. I mean, these things were down for the count, bogged down with regulations, with low interest rates. Now it's possible that we might get back to business, right? The business of America is business, and banks would benefit from that. That's why banks are doing well. That's why commodity stocks are doing well. That's why industrials are doing well. And it's not this fantasy land of negative interest rates with the Fed. I mean, I absolutely agree with the policy that it was necessary with a guy like Obama in office. And I'm sorry I'm getting a little political here, but having having some pro-growth policies that are going to lift the economy up. The only way out of the debt and the stagnation that this country has been in for so long is to grow our way out of it. And we have an amazing opportunity here. I do believe in American exceptionalism, and I believe that we could really lead the way for the world. After all, we kind of started this problem here with the mortgage crisis, and it cascaded into other markets. So maybe we could lead the way out of it and show that there's a better way. Anyway, with that said, let's start getting into some ramifications and how to trade this sucker. Anyway. So you have a couple of, and that's what I have to say with regard to, with the jobs and with the economy. Everyone who's who truly is out there on the streets can feel it. I'll tell you one more last thing on this. I've had friends of mine who've had to move out of New York because they can't afford it anymore, or they can't find comparable jobs after they were either laid off or downsized, or positions were eliminated. It is not a pretty scene. So God forbid they were to let the economy run a little hot for a while. I mean, maybe if they could get to 5 or 6% growth, that would be absolutely incredible. You would solve the debt problem. It would solve tons of issues. Anyway, let's get into what you guys had mentioned you wanted to talk about, and we'll talk about some of the markets and the major market indices here. So today. The story of today was a combination of a few things. This is how I kind of started my day. I started to look at what was moving around, and I noticed early on that the dollar was getting absolutely monkey hammered, and that was very, very good. My biggest fear for the market, and I've had it out with some other people who are kind of like me, like-minded, except we disagree on the dollar. I think that the dollar, we don't live in a vacuum. We live in a world where other countries manipulate currencies. And it's very difficult for American businesses to compete. And a lot of S&P 500 companies do business overseas. And when they repatriate their money, they don't do as well with foreign earnings when you have a screaming high dollar. So today, the fact that the dollar was backing off, I sort of figured that the market would be strong. Enter oil. The market was rallying pretty solidly until you had that oil inventory data that came out that was actually very bullish for the price of oil. If you only looked at oil, it was a huge drawdown, but I wouldn't say equally, but concerningly, you had this huge build in distillates and gas, and that caused the pullback, because that's sort of the leading indicator of it. I thought it was a bit more of a pullback than it should have been, and I actually wound up being correct with that, because oil wound up rallying pretty solidly off the lows. I don't think it finished on the high. Let me just take a quick look-see here. But it didn't finish on the high of the day, but it finished above the prior day's high, and we're still inside this big candle day range. You had a big kind of outside reversal day, but still within the context of range in oil on 1.3. And as long as we're in that range, I'm sort of neutral on oil. Below 52.11, which is the low of day of that bar, we have to start, and below the 20 MA, we have to start getting more concerned. But as long as like 52.11-ish, 52.22, that area, that's the failed head from the possible head and shoulders. As long as we're above there, the risk in oil is higher, to 56.5 and maybe even to 62.5. If you start getting back below there, we could start thinking about maybe 51s and potentially a 50 MA test, even back at the lower end of the real full range, down at 49s. So it sort of needs to hold 52. 52 is a big, big level, needs to hold. One thing that had me a little concerned was, even though oil kind of righted the ship, big integrated names like Exxon were very weak today. Exxon finally filled the gap. I was sort of unsure if it would or it wouldn't. It took a while, but it did. And now it's into a big level here. 89 was the breakout. We finished a little bit below there, but we held onto trend line. You also now have a huge confluence of moving averages all right below it. I had said for a while that 82 to 86, I think it was, or maybe it was 83 to 86, was the key support. It's now shifted up here to 87.44 to 89.01, and I'd be willing to give it a little bit of give to the 100 MA. So you have the 200 MA at 88.02, the 50 MA at 87.65, and the 100 MA at 87.13. So that area needs to hold here, and I'm fine with either right or right out with shares, or better still, selling out of the money puts. You have a gap fill to 85.90, so I like strikes 86 really there or below to sell out of the money puts. So I don't know what your time horizon is. If you want to go longer dated, I like 82, 83. If you're near dated, around the gap fill area. So that's the deal with Exxon. I'm just going through the list. I'm going to just go through this list in order, I think, although I stepped out of it a smidge with Exxon, but that was really just because we were talking about oil. I'm going to take a little liberty, actually, and jump around. So, because I'm just looking at this, and there are some things I want to discuss that we need to discuss, and that they're more important than, like, some speculative name here. So, let's talk about volatility for the moment. VIX kissing the canvas again. I had said I thought we would get up to the 200 MA. We did, and it backed off really badly. Today, we had a bit of a look below and fail of that 1153. Yet what you have to understand about the VIX is that it has an inherent value. It's never going to zero. It's, anytime you get at close to 10, it's sort of like an asymptotic relationship with 10. If you want to look that up, go ahead. I don't want to explain mathematical terms here. But you can always approach that area. Once you get through, it's rare. I think there was one tusk below that I could remember in modern history, and that was in 2007, and that was right before the crash. So you want to kind of hold this area. It's okay. Just because volatility bottoms doesn't mean it necessarily has to immediately go higher. It could just stay choppy in range. And it didn't surprise me that we saw a little bit of a spike up in volatility. This is all very normal. What starts getting to be a problem with volatility is when you start making higher lows, and today if we were to bottom, we do have a bit of a higher low, but once you start making higher lows and higher highs and the market isn't cooperating. So that's the skinny with this. I think that this is just going to bang around in sort of a more compressed range. Eventually, compression leads to expansion. It's just destined to happen. That's the way the stock market works. But I prefer, rather than playing VIX options directly, the truth of VIX options is you'll never make consistent money on them unless you get outsized moves that are outside, because they tend to be priced fairly expensively. The better way to play VIX is with my graph and playing directionally with premium, either being long or short premium based on where you are in that spectrum. Here we're in pure directional play, and if you want to play the low VIX and play it for a bounce, buy some long-dated put options in like the S&P or in the IWM or something as either a hedge or a directional play, and just realize that, you're just basically playing the range here and you're getting into, options at a fairly cheap price. Speaking of the said indices, let's start out with the top of the key with SPY, because SPY really is the market, even though we're all on this Dow 20,000 boondoggle. You're holding over the 10 and the 20-day moving averages fairly decently. This is a decent consolidation here in range. I'll say this, you have 2 days now. Today was a bit of a look below and fail. If you can get over the 2-day high, today's 2-day high, I think we'll see the all-time high and maybe even still higher. If you get below the 2-day low and crack the 10-day, I think we may want to revisit sort of the lower end of range. At some point, I don't know when this will happen and where it'll be at the time, but the 50 MA was the major resistance in the market for a while. It was like grim death every time we touched it. That is now and should be solid support when we hit it. You may pierce through it intraday if you're coming down hard and fast, but the 50 MA to me, you have all your major market indices basically hanging out, doing, letting the MAs do catch up. A lot of people keep telling me, oh, the market is so overbought, it's so overbought. You're right on the 10-day, you're right on the 20-day. There's no extension there. And the 50 MA is down at basically around the breakout. 219.60 was really the big breakout. You could say 217.03, but 219.60 was the last reference high. And now the 50 MA is caught up. It's over 220.23. So it's actually good that these MAs are kind of catching up a bit. It gives the market a chance to work off some of the overbought condition. It was definitely overbought. I had talked about that we would see a channel high test and that I didn't know if it would be an easy short. And it sure hasn't been. You've been very choppy. It looks like it's going to break down. It comes back up. So I like it either long over the 2-day high or for right or right out long, or short below the 2-day low for a right or right out short. That's very often my story when I wind up seeing you guys and gals. The Russell yesterday looked like it had a look below and fail with a higher low, and then looked like it was breaking out of the kind of consolidation channel high, and then today it was really weak. It actually pierced the low. It was actually the weakest of the of these indices, but it wound up kind of still closing inside of range and being, I guess, okay. That 50 MA is fast approaching as well, but it's kind of close to where the gap fill was now at 130.90. So I think if you started getting above, first of all, the 2-day highs, we would very easily see it's a hop, skip, and a jump from the old all-time high. It's basically now in a move to the middle of the channel. On a longer time frame, you have a 1.618 fib extension up at 150.101, but we did get my channel high in 138s, and I said I thought it was a sell. I said I didn't necessarily think it was a short, though, because I thought we would consolidate sideways, and that's exactly what's happening. If we were to lose the range low again here, I'm using 134.81, although now we could kind of extend to these look below and fail bars, basically 134.40 to 134.5. If you start losing that area again, I would countenance a right or right out short for a setup there. I think you could even, like I said, use today's range as a tester. We closed a little bit below the 20, but held the 10. We could continue with this, but like I said, a quick right or right out trade, either above the high, I think is okay, below the low you can try, and then it would be an add below that range low for a tester. One of the things that has me a little bit constructive is the NASDAQ is starting to participate. That's actually almost at an all-time high again. The Qs are, I think the NQ, let me see, the NASDAQ, let me see, /NQ. No, we're not quite there in the NASDAQ futures, and the Qs aren't there. Let me just see one thing. No, NDX isn't quite there yet either. So the Qs, that was the strongest, and that has been sort of the relative weakness. So if the Qs can start participating, that could also now begin a whole new potential leg of this rally if it does continue the participation. One thing I saw today that I had that was glaring on my screen the last couple of days was the relative weakness in Apple to the market. The last couple of days you've seen some rallies, and you didn't see very much in regard to Apple. However, it has basically still done everything right here. It pulled back, it held the 20 MA basically to the tick. Yesterday stopped shy of the 10-day. Today, I think we actually closed a little smidgen above. Yeah, we did. We closed above the 10-day moving average, which is good. I noticed something in Apple today that I haven't noticed since the very end of last year when I talked about bailing on the stock. This was like around, I think, the 20th, 19th or 20th. I've been noticing, I had talked about for a while that I was noticing sort of a larger buyer in Apple. I wasn't sure if it was the buyback or a big buyer. I narrowed it down to saying I think it was the buyback because I was noticing it strong throughout the day except in the end of the day. Today it was all day I saw this kind of buying in Apple. Even when the market was weak, Apple wasn't as weak. It did come down, with the futures and stuff, but you could just tell the way a stock behaves when you follow something for a long time. They have a personality and a character. And today, for the first time in a while, it seemed to me like that buyer might be back. So I liked Apple. I think you could use the today's range. Let's keep it simple with the 20 MA. As long as we hold the 20 MA, I'm okay long. If you lose that, I like it short to the 50 MA. So we'll keep it that simple. Facebook, I mentioned yesterday, I thought, actually, yeah, we'll just do Facebook because we're already talking about Facebook. Yesterday, I talked about a write-out trade to the 200 MA, and that got there. I now disavow anything. We got our price target. I talked about that 50 and 200-day confluence. We got it. It's now going to be a little bit of a show-me situation because we're into some past resistance, although I do like that we closed over the 50 and the 200 MA here. So I would say if you're long, I wouldn't let it get back below the 119.66. That was the prior day's high, and also kind of like midway through this candle here. But if we can hold over here, it could rally. Unfortunately, my better setup for Facebook would have been more of a breakdown ahead of the earnings. The worst setup to me would be, it would be great if you're long, would be if it rallies in and gets the gap fill and then gets nailed again on earnings from a lower high. Then I'm going to start really getting a lot more bearish on Facebook. But right now, I like the idea that we're testing into this level. If it can hold the 50 and over the 200, I think that it could get the 100 MA, which is up at 124s. But anything back below those, we're going to still be in iffy mode here. That's very important. Amazon, also today, I talked about this being a write-out long over the 50 MA, and this thing just blew up, very quickly. We got basically to the 100 MA. I had, you know what I say, if you lose 10 day MAs, we get 20 MAs. If we get over 20 MAs, we get back to 50s or 100s. 50s, and if we get over 50s, we get hundreds. And today that played out. No break in range. Believe it or as crazy as this sounds, I know today the stock was up huge. There has been no pattern repair, other than the fact that we are over the 50 MA, which is good. We stalled on the backside of sort of the old uptrend. It had broken, and now we're on the back end of it. You really need to clear 792.40 for it to get bullish again. If there was an early pullback tomorrow, like if you weren't in it today, if there's an early pullback tomorrow, like to the 50 MA or midway in, I'm fine with a write-out buy there, and then using low of day as a stop. If you could get over to today's high tomorrow, obviously your trade location isn't spectacular, but I guess you could play it that way also. For me, the best setup would be if tomorrow was like a small inside doji, maybe like a day or two of that, and then if you could clear like a 2 or 3 day high, then you could extend and maybe play for the gap fill. So I think what's really happening today with Amazon was what I was talking about a few days ago, that I thought Amazon was going to have a really good quarter, and I think people are realizing that. Oddly, because of the fate of other retailers that are getting slaughtered by them. Kohl's got nailed big time after hours yesterday on a miss, and Macy's as well, and they're closing a ton of stores and laying off like 10,000 people. So, that's some real pain. These malls are getting slaughtered, and I think it's because people are using their smartphones and ordering on Amazon. Honestly, if I want to buy something at this point, I don't ever buy it anymore without checking to see if it's cheaper on Amazon, or if it's not cheaper in the store, I'm just going to order on Amazon because I don't have to go to the store and deal with incompetent help there. I went to Best Buy a couple of days ago. My printer broke and I needed to print something out. By the way, Epson is a fantastic brand printer. I'm so happy I got one. I got a new printer, and I'm loving it. HP is really putting out junk, but Epson, 2 thumbs up. And to get a salesperson and then to get someone who knew what they were talking about, and then it was just such a painful experience. I almost ordered it on Amazon, except the guy, I really needed it that day. So that's the scoop. I mean, like if I want to buy vitamins or anything, I mean, more often than not, particularly if you're a Prime member, you get your stuff cheaper. Like an example is like fish oil or my multivitamin I take. It's like $20 cheaper on Amazon. It's absolutely incredible. I mean, I can't even believe the deal, and I get the free shipping. So Amazon, I said anecdotally, I looked out of my car one day. I do a lot of my stock research in my car, right? I see homeless people and I see Amazon. Maybe they got to hire those people to work at Amazon. So I noticed that they were unloading this big, huge truck with a stack of holiday boxes, and like 85% of them were Amazon. Again, I looked in the package room in my building. I live in a big building, and almost all the boxes are Amazon. So I think that, and we've seen that the market share has been going on to online, and that to me is Amazon. They have built out an infrastructure that is incredible, and I think a lot of people think that retailers are going to be able to catch up very easily. They are not going to catch up very easily. This was said about Netflix. This was said about tons of companies. These are real brands now, and they're here to stay, and they're run by very smart people. So someone asked me, what's the best way to be long Amazon? The best way to be long Amazon is to be long Amazon. Don't outthink it. I mean, you could do it with a call spread. You could do it with a risk reversal call spread. If you're worried about the downside, or if you have margin limitations in the account, you can sell puts and then buy puts below it to reduce the margin risk. I like call spreads. Sell an in the money put spread. I don't like selling anything in the money. I like either selling at the money where the premium is the most jacked, or below the money, because your probability of success is better if it's in the money. If the thing drops, you have some issues. I mean, obviously, when I always use the example of at the money, but it's sort of the Shakespearean line from Julius Caesar. When things are taken at the flood, you could go on to great opportunity. Go on to great fortune. That was the line. There's a tide in the affair. I think it's the tide in the affairs of men. When taken at the flood, can go on to great fortune. So that's the I either like at the money or below out of the money, so you have a little bit of cushion. If it's in the money, it gets a little iffy. When I like buying in the money is in the money calls, and then selling out of the money calls is sort of my my spread. Because if you buy out of the money calls, everyone gets so excited. They buy these cheap out of the money calls, and then they once in a while they blow up and they become huge. More often than not, they are zeros. So I like just having a high probability of success. If you're going to sell puts in Amazon, I would go below the last swing low and below the 200 MA, which is currently at 237.32. So something around 730, I guess. And then you could use that to buy a call spread. I would wait right now, just see if the 100 MA. Listen, we blew up to the 100 MA. This is right into the last swing high. Wait to see either if it can clear, or like I said, buy some type of a retracement into today's candle and then use the low of day of that candle as a stop. A lot of people ask me with options, how do I decide my stops on the option? I base it on the stock. If the stock breaks my levels, I'm out of the option position. I always base it simply on the stock. Baba, that was another one that started to participate big league today, or bigly, however you want to dice it. I talked about in the weekend review video that this was sort of a big level for this bad boy, that it needed to hold these 86s, and that I thought, if it could break over the 200 MA, it could be a long, and this thing really, really took off. You had 3 days ago, you had a gap over the 10-day. It didn't really go, but then like the last 2 days, it's really gone. So we're now back over the 50 MA, and that's about halfway through today's bar. 50 MA, right or right out. If there was an early weakness tomorrow to the 50 MA, you could buy that and use the low of day as a stop. This probably has some clearance to like 98, 100 if it's going to keep going. The 100 MA, which has been some resistance, is up at 97.66. So maybe start to scale out if it got up to there, and then hold a little, and then trail the stop. I mean, this is how you trade, right? But yeah, that looks like it today was almost a professional gap. Yesterday was up, and then today was a gap and go over the downtrend line. So I'm all right with the BABA as long as it holds 50 MA. That's a reversal for me because I had been bearish on the stock up until, I guess, the move over the 200 and now the kind of confirmation. So needs to hold. If it gets below today's low, like if tomorrow is below, or you spend a couple of days and then it breaks, it's a short again because it was a failed breakout. So today's range is very key. Baidu, not one I follow as regularly, although believe it or not, I used to trade this thing like a beast back in the day. This has moved a lot. The pattern is starting to shift. You have a trend break. You have a higher low. You're over the last swing high. The 200 MA is a little fungible in this, but anything, listen, you have a 200 MA and a 200 and 100 MA confluence. As long as you can hold those, I'm okay with being long. If it loses it, just GT FO, and I'd probably be looking maybe if there was like early weakness again, like on something like that, to buy and use as a stop. Nike, I was actually short. Then I got stopped out with that little BS upgrade. I didn't buy it though. I was close, but I didn't like the way it closed, and now I'm actually considering the long again. Today was weak, but it held where it needed to. We're right under the 100 MA. So if you could punch through that 100 MA, I think we would see the 200 MA like a couple of bucks higher. So I like the 2-day range. Above the highs, I like long. Below the lows, I like short again, actually. I may have to put in a buy stop or a sell stop in on those. This NVIDIA, again, it had that downgrade from Andrew Left, who is, the short seller. And it's holding the 20 MA, albeit. So the 20 MA has been big support. It needs to hold. I would be you have 3 days now of consolidation in this range. So below the 3-day low, I like short to the 50 MA. Above the high, so the low of that bar was 99.38. I talked about a right out long there. It actually took a little while, but it wound up bouncing. We're still below the 10-day. So we need to get above 106.37. If it can do that, I think it would probably start repairing higher. I really would like a 50 MA. That was the big support moving average before this thing just went vertical. 50 MA test, I think, at the very least, for the initially would be a good right out long for a trade there. Talked about Baidu. Tesla, this is back over the 200 MA, oddly enough, although 230 has been like grim death for this stock. So you have a big breakout bar over the 200, and then today is a inside consolidation day. That's what I would love to see in Amazon tomorrow. Over the 2-day high, it remains a long. Below today's low of day, it's a stop out and maybe a short back to the 200 MA. So I like today's range as a guide. Above the high, I like long. Below the low, I like as a stop or a short. Goldman Sachs. This just looks like it's in big consolidation mode, still holding the 20 MA. You have a range low, consolidation range low of 235.37. If you violate that, I think it sees the 50 MA. If you get back up over the highs over 245, I think it sees 268s. So that's that. What else do we have here? I talked about Nike. Citigroup, I think, is the same kind of a situation. Basically, you have a range. The range low this was actually a look below and fell on 1229, because the range low there was 58.76, and this looked below at Oh no, is that it's an equal low? Sorry, 58.76, and this is 58.68. So it was a look below and fail. Yeah, I mean it's the same situation. You just take that range. If you get above the highs, it'll probably go higher. If you get below that 58.68, it's probably a quick short down to 56, which is the 50 MA. I think all of these things are going to be plays on the 50 MAs for bounces at least the first time. Whole Foods, this is one that I've played games in for a while. I sell puts on the lows and then take them off and then wait for it to come down and then sell them again. It's just consolidating. It feels like I know they have a buyback, and like this 27 to 29 area has been key for a while. It seems to me like this is the same situation. When it comes down, sell the puts. When it rallies, take them off and just keep rinsing and repeating. It feels like they're building a base and that eventually something has got to happen with this. So that's the scoop with that. Someone asked about Apple. I already discussed Apple. If you missed it, watch the rebroadcast of this on my YouTube channel. No, I don't know Jordan Belfort. Someone asked about the Wolf of Wall Street. I don't know him. I don't associate myself with criminals, by the way. Although I believe he's done his time, so I don't know. I probably have a beer with him now, but no, I don't know him. So Freeport McMoran. This has been part of the Trump trade, right? The reflation. I'm dying for this thing to come down to the 61.8 of the range, down at 11.98, which is also the 200 and 100 MA confluence to buy. It didn't. It's now rallying instead. It broke the trend. So over the 20 MA, I'm fine with it being long. Above that is fine. Below gets a little more iffy. You have 50 MA below. I mean, this thing to me seems like it's going to eventually work its way higher, but I really wish I could get that flush lower first, but can't always get what you want. I had played this long. I got out, and then I've just kind of never looked back. I think I got out a little bit too soon. I forget what it was. Might have been 14 or something. But this thing has been beasting, right? It's anything above 1406 is which was the old reference high, range high. I think is still long below, then gets a little more iffy, and you have the 50 MA right below there. So very key area to hold. Someone's asking about these beverage stocks, the Budweisers and the Diageos. I don't really follow these that often. I don't know what the heck happened to Budweiser. This thing got absolutely slammed. You have a bit of an island reversal down at the 98.28. I was hoping for a move in this a little lower, down into like the 92 or 82, which is like the 50% and 61.8 fibs. That doesn't look like it's going to be in the cards, though. So you're now making some higher lows and some higher highs. Today was a test of the 50 MA. So what am I thinking with this now? It looks like a wedge to me here. As long as it can hold the 20 MA on pullbacks, I'm all right with it long. Below there, I would probably be looking to stop out. That to me looks like a key moving average. The upside targets, just throw a Fibonacci on it. The 112.81 is the 38.2, and then the 50% fib is 117.30. The real volume starts where that breakdown is at 112.81, so you might be able to make a bit of a run up to that area. Diageo, not one I follow very often either. This had a lot of, I mean, I feel like a little late on this. If you were buying it there, all the reference support was down here closer to like 100. It ran to like this 106 level. 50 MA was where this broke down from. Any 50 MA test, I would be a buy the dipper. I would say you could buy long over this 107s, but my problem is that the 200 MA is at 109. So I'd prefer a 50 MA. I'd prefer this on a dip than to chase. Just, I mean, you might miss it, but that's just the way I see it, you know. Sometimes you can't always get them. Allergan, someone was talking about this. This has big hedge fund support. The 50 MA was the support, then the resistance. It should now be support again. It's into the 100, and just with the 200 above it, it's probably a little late. I'd wait for a pullback, maybe to trend. If you draw a trend from the 12.7 low, you could just throw, wherever it tops out, throw a fib on it, and then like look to buy one of the, like the 50% fib maybe. Better still is to draw the trend line in. This is starting to get a little bit steep. If there's any kind of pullback to trend that it coincides with like the 50 MA at that point, I'd be into it. But now you're off the lows a lot and you're into like the 100 and the 200 MA. I'd probably be looking more to sell it there than to initiate. But it does look like the pattern is starting to shift. All right, so that's my story, and I'm sticking to it. We went a little longer than I would have liked, and I got to get going to make an appointment. If you missed the video, if you want to watch it again, you should be subscribed to my YouTube channel, which is Justin Pulitzer Trades. If you're not following me on Twitter, my handle is @JustinPulitzer. So I will post the rebroadcast of this video at some point this evening. I'm going to try and get it done now before I leave, but we'll see how fast the upload time is. Someone asked where the Blue Lives Matter shirt is. I had said I was doing that until New Year's, but as a special to those who like it, I got the cap on now. So maybe I'll start wearing the cap or alternate a little bit. I think I'll wear that shirt though on all Fed days to continue the I don't know, the movement. There's a movement. Anyway, that's my story. I'm sticking to it. I hope you guys and gals are off to a good new year, and I'll see you on Sunday with the weekend review video. So have a great week, and cheers.